practice note number 99, which is entitled Financial Management for Consulting Engineers. I will be your moderator for this webinar. My name is Wally Main, and I'm a civil engineer occupying the position of Contractual Affairs Manager at CESA. I'd like to inform you that the webinar is being recorded, and the recording will be available on the CESA website after the webinar. It'll be under the YouTube icon, and the link will also be forwarded to you, our delegates. Just some housekeeping. On the taskbar at the bottom of the screen, you will see the chat and the Q&A icons. Please use the chat for any comments you may have, and the Q&A for your questions, which will be addressed by the presenter at the end of each of the sessions into which he has divided his presentation. I think there are about 4 sections. Going back to the topic at hand, infrastructure development has been identified by government and our President, Mr. Ramaphosa, as one of the most important mechanisms for achieving job creation and economic growth in our country. And of course, critically important to successful infrastructure development is the employment of professional service providers and construction contractors who are able to deliver functional infrastructure as envisaged and intended by the client. The process of infrastructure development starts with the procurement of professional service providers, such as consulting engineers, and hence the practice note has been developed to raise the awareness of member firms to the value of sound financial management principles and their contribution to ensuring the sustainability and profitability of the firms. By following these principles expounded in the practice notes, members will be able to avoid the costly mistakes typically made by those who are not exposed to or do not follow these principles. A PDF version of the practice note, PN99, is available to members only on the CESA website. Any other consulting engineering firm wishing to access the practice note or any of the other practice notes that CESA has, of which there are roughly 100, is encouraged to apply for CESA membership by contacting Ms. Gillian Wands at gillian@cesa.co.za or phoning 011 463 2022. And that way they'll be able to apply for membership and have access to the practice notes. Pleased to say that the presenter and author of the practice note, that is the subject of today's webinar, is Mr. Simon Berry. Simon is a chartered electrical consulting engineer with an MBA from Cambridge University in the UK. His career includes a period as the commercial director at CESA member firm WSP, and currently he is the founder and owner of Fresh Projects, which amongst other things developed the well-known graphical comparison of the guideline fees of the various built environment professions. Just like to inform you that the practice note has been vetted by the practice note subcommittee of the CESA board committee, which is responsible for quality, risk, and sustainability management within CESA and CESA's membership. And so we trust that you'll find this webinar and the introduction to practice note number 99, entitled Financial Management for Consulting Engineers, to be both informative and enjoyable. And so, ladies and gentlemen, at this point, I'd like to hand over to Simon Berry to deliver his presentation. So it's over to you, Simon.
Good afternoon, everyone, and thank you for having me. Right, I'm going to dive straight in, and today we're going to be covering 4 main areas. So first off, we'll just talk a little bit about the 3 types of financial management tools that you need to be aware of and what the differences are between those. And then we'll jump straight into just what we believe is the 3 single most important things that you need to worry about in terms of running a profitable practice, which is making sure your projects are profitable, managing cash flow, and winning the right type of jobs. And we'll go into all of those in a lot of detail in just a while. But firstly, just to, Wally did do a little bit of introduction about myself, but just what qualifies me to talk about this today. And I am a chartered electrical engineer. So I've worked in the industry as a consulting engineer for many, many years. And that actually led me, a lot of this was done in the UK, which is why I've got the chartered qualification as opposed to the PRN. But at one point, I got to a point that after about 10 years of working as an engineer, and I looked at all my friends who were working in finance or as management consultants, and they'd studied engineering with me, but they'd never actually done engineering. And they were earning 5 times, 10 times what I was earning as an engineer. And I was fed up with that. And I said to myself, okay, I'm going to go do an MBA, which was my next step. And I'm going to transfer from being an engineer, and I'm going to become a management consultant and make lots of money. And that year of doing the MBA was brilliant for me for 2 reasons. Firstly is that I realized, because I met a whole lot of people coming from finance or coming from management consulting, and they told me just how terrible it was to be one of those. So I realized the grass wasn't green on the other side, and that I actually loved engineering, and I wanted to stay in it. And because I think when you're born an engineer and you want to solve problems, that's what you like to do. And the second important thing I learned from that year was just that the stuff that you learn about outside of, so engineers learn a lot of technical things about what they're good at, and they think that the things that other people do is rocket science, like whether that's accounting or marketing or any of those other things. And what an MBA is good at is giving you the introduction to all those different fields, and you realize that it's actually not rocket science. And you'll see today in today's presentation, everything we talk about is not rocket science. It's you already know it, you just need to apply it. So off the back of that, I decided to use that knowledge now that I had, engineering background and the now finance elements and accounting elements that you get from the MBA, and try and make a difference. So I went and I worked for a few years as a commercial director at WSP. And there we spent a lot of time, a lot of effort, and a lot of money trying to figure out just how our projects were being run profitably. So understanding which projects were making money, understanding which clients we should work for, and understanding are people working effectively. And that is, like I said, we spent a lot of money and time trying to do that, and a very difficult thing to do in a consulting firm which sells time. And there are not a lot of tools out there that support that. And we actually struggled to do that properly. And at the time, I looked around for a software solution that would allow us to be able to do this easily. So basically answer those 3 questions: which projects are making money, which clients should we work for, and are our staff working effectively? And there wasn't a lot of software out there that was specifically aimed at the built environment and the way that we work. And that's what led me to go off and create Fresh Projects. So what Fresh Projects does, for those who don't know, is it's just an online web app, and it allows you to work out what a job's going to cost you to deliver, what fee you should charge, track your costs against that, and bill your client. So all the financial aspects around running your project, but more importantly, tailor-made for the built environment, so that you can understand exactly where your projects are making money and where they're not making money. Okay, and through this journey that I've done with Fresh Projects now for the last 10 years, we've actually now got many hundreds of companies using our software, and we get a very unique insight into the market. And this is not just in South Africa, but around the world. So in UK, Australia, and Europe, we've got many businesses running their projects through our software. So we get to see the database of hundreds of thousands of projects, just what it costs to deliver those projects in terms of time and expenses, and how people are invoicing them, how they're doing their fee calculation. So we've got a very unique insight into the market. And that's kind of what I'd like to bring to you guys today, is just the learnings that we've learned through dealing with, like I say, hundreds and hundreds of different built environment practices, all trying to do what you're doing, and understanding what works and what doesn't work, and what's important and what's not important. So hopefully that gives you a good understanding of where I come from. Okay, so let's kick off and just think about what it is that makes a business successful. And to me, this is just one thing, is if you want to succeed, you need to be profitable. And engineers are not very good at this. We love solving problems. We love a client who comes to us and says, I need you to design this amazing thing. And we will work for free for hours and hours and months and weeks for weeks, because we love the challenge of that problem. We're not inherently good at worrying about money and making sure that we're making money. So if you compare and contrast our personalities to a lawyer or an accountant, they will look after the money first and then do the work, whereas engineers just want to solve the problem and we don't really focus much on the money. But we need to, because we need to make sure that our industry is profitable, and it's okay to make a profit. It's good to make a profit. In fact, you need to make a profit because we all need to grow. We need to attract and retain the talents, and not like me when I was sitting in London looking at my friends making lots of money in other industries. We want to make sure our industry is lucrative and that we can keep all the good engineers working in our industry. And to do that, we need to make money. So what we're doing today is critically important for engineering and the built environment. Okay, so to that point is there's really, in my opinion, just three things that you need to worry about. So there's obviously dozens, hundreds of other things you could worry about that involve finance, involve project profitability. But if you just focus on these three things, then you're going to do well. And like I said, we've seen this through our interactions with hundreds and hundreds of successful and unsuccessful businesses that we work with. So number one is make sure that your projects are profitable. Okay, so not just about your business, and we'll go into that in a second, but project by project to understand that they're profitable. And like I said, this isn't rocket science. You just need to spend less than you earn, or you need to earn more than you spend. So you need to get your fee right, and you need to make sure you don't spend too much time on projects. The second thing is cash flow. So understanding when the money comes in, not just how much. And we'll go into that in a lot of details, but in the nub of that is just to make sure that you invoice as soon as you can and you get paid as soon as you can. So don't let bad debt grow. And then the third and final thing is about winning work. So winning jobs and making sure you win the right type of job. So we see lots of businesses who take on work that they shouldn't take on work. Understanding what's the right type of work for you is important, and then going after those type of jobs. And we're going to go into each of those in detail, but first, just a little bit of background on the three different types of financial management tools that you would encounter when you're dealing with project finances. And the first one is what we're going to call corporate accounting today, or just accounting. So this is, if you know an accountant, you know a bookkeeper, you know anyone who does accounting, this is what we're talking about. It's the traditional way that accountants measure the performance of businesses. And the important bits about this is that it's focused at the company level. So accounting looks at an entity, it looks at a business, and it looks at all the income and expenses in that business, and it tries to analyze that. And that's good, obviously, for looking at a business, but it doesn't help with that first point that I was talking about earlier, which is understanding a project level accounting. The other important thing about corporate accounting is, by its nature, it's backward looking. So you always do your accounts looking back at the previous month or the previous year. So you don't have any insight into what's going to happen in the future. And while it's important to understand how you have performed historically, you also need to keep a view ahead and understand where you're going as a business. The second type of financial management tool that you'll come across, or that's important and you'll come across, is what we would call project accounting. So this is a similar approach to your corporate accounting, but it is based at a project level. So it is worrying about your income and expenses at a project by project basis. So how much have you spent on each project? How much have you earned on each project? You can also do it at a client level if you wanted to. And the important bit about this is that it's in real-time information. So you're looking at, because we work daily, weekly on projects, is you can very quickly, even within the period of a month, you can run into trouble with a project. So to have real-time data on this is quite important. All right, and then the third sort of financial management tool that you need to worry about, like I said, is forecasting and budgeting. So the previous two items, the accounting items, are generally backwards looking. They're looking at how things have progressed up until now. And then we also, the third tool is need to look forward and say, okay, what if, what's going to happen in the future? If I win this job, if I don't win this job, if I get this employee joining me, if I don't get this employee joining me, what are all the various scenarios that could play out in terms of our financial forecasts in the future? And again, we'll go into that a bit later. All right, so just quickly, so I spent probably a lot of money on trying to get an MBA, or I did get the MBA. And one of the bits I enjoyed the most about it was a package on, or a module on accounting. And it kind of demystified it for me, because again, like I said earlier, all these other professions that we think are doing black magic, it's not actually that complicated. They do use funny terms to try and make it sound complicated, but it's not. And the main takeaways I got from the accounting part of that, I'm going to try and share with you today. And there's really just 3 bits of accounting that you need to worry about. And they are, the income statement is the first one. And again, this is not rocket science, and a lot of you might already know this. The income statement is often called a profit and loss as well. So if you hear people talking about a profit and loss, it's the same thing as an income statement. And what it is really just looking at 3 things. Is what is the income that you've earned as a business? That could be within a period, so within a month, within a year, within a quarter. So how much have we earned? What is all the money that's come in? How much have we spent? Or what is all the money that's gone out? And then what is your profit and loss? So that's why it's called a profit and loss. So the profit or loss is just the previous 2 numbers subtracted from each other. So obviously the idea is to try and spend less than what you earn, and that will make you a profit. Okay. The critical thing to understand here, where it'll click for me, is that what an income statement is showing is a movement. So it's from the 1st of January to the 31st of January, what happened during that period. And the net result is how much did your business's value change? So if you make a profit, your business value is going to go up. If you make a loss, your business value is going to go down. And that leads us into the second sort of tool that accountants like to use, which is the balance sheet. Now, a balance sheet can be very complicated. As you know, I should have mentioned, the profit and loss, or the income statement, can be very complex. I mean, lots of different lines in it, but the important bits to worry about are the 3 main sections. How much have we earned? How much have we spent? And what is the net result? Likewise with the balance sheet, is this consists of 3 components to it. The first is your assets. So what is everything that we own? So it's not about change in things over time. It's just at a point in time. What is everything that we own? What is the value of that? So if you owned a civil engineering construction firm and you had a lot of bulldozers and graders and things like that, there's a value to that. For a consulting engineering firm, the things that you own that can be tangible, that can have value attached to them, are your cash, so how much money you got in the bank, and all the invoices that you've issued that haven't been paid. Those are the 2 main things. And then your liabilities is the opposite, is what is everything that we owe to others. So all the bills that have got sitting in our inbox that we need to pay, how much is the value of that? Any debt that we have, any loans that we've taken up, what is the value of that? And the difference between those 2 numbers is your owner's equity. That's how much your business is worth. So obviously over time, you want to make sure that your assets are bigger than your liabilities, and that'll be how much your business is worth in an accounting sense. And this is a little sketch that I've got to try and show you how those 2 things fit together. So the income statement and the balance sheet. So the purple bars are your value of your business, and hopefully over time that is increasing, as you can see in here. And then the change in value from month to month is your income statement. So how much did we increase? So if you have a profit, the value of your business is going to go up. If you have a loss, the purple bar will go down. So yeah, I think the net result of all of that, balance sheet is a snapshot. What is the value of your business? Income statement, how did the value of my business change? Okay. And then the third thing you'll hear a lot about in accounting terms is what we call a cash flow statement. Again, this can be very complicated, and it's more useful, I would say, in bigger companies that have got, thousands of people working for them. And it can be very detailed, as you can see. I mean, this example isn't even that detailed, but there can be a lot of lines to it and say cash spent on this, cash spent on that. But the way I like to think of it, and it's certainly the way that's relevant for SME type businesses and consulting engineers, is really just how much cash did we get in and out in a month? How much did our bank account change by? So in July, we got a lot of money in and we didn't spend a lot. So this is important to obviously understanding you don't go bankrupt. And that's why cash flow statements are important in the accounting sense. But we'll talk about cash flow more generally in a minute in terms of invoicing and collecting your cash. Okay. So out of the three sort of main elements of accounting, I would say if you're going to worry about two, is worry about the income statement and the balance sheet. Cash flow is critical, but at the end of the day, it's quite simple. It's just about money in and money out. All right. This is my top tip for accounting. So corporate accounting or traditional accounting is just don't do it. So there are other people out there who understand this better than you, who are better at doing it than you, and they can do it for a lot cheaper than what you can do it. And I know it may, if you're starting off, it may sound like a lot of money, and you might have to do it initially when you start off. But you, as an engineer, are employed by your client to solve their problems, engineering problems, and you're much, much better off spending an hour of your time earning fee on a project than you are doing invoices and balance sheets and whatever else you want to do. So as soon as you can afford it, outsource this. For a few $1,000 a month, you can get a bookkeeper, you can get an accountant to do your accounts, to do your submissions to SARS, all those things. Let the professionals do it. They do it day in, day out. They've got the tools to make it efficient for them. They've got the knowledge how to do it. Just outsource it. Okay. All right. So that was corporate accounting. I'm now just quickly going to go into what is project accounting. So you remember we had three different types of tools. So this is the second tool. So project accounting, like I said, is just like the income statement that we dealt with at the business level, but this is done at project level or client level. So we need to understand at project by project basis just how much money has come in, or how much money have we earned, and how much have we spent. And the trick here is to make sure that you distribute all your costs to all your projects. So if you're incurring costs as a business, whether that's a license for AutoCAD, whether that's your rent, your insurance, all those things, those costs all have to be attributed to your projects, because at the end of the day, it's your projects that are earning you the money. So when we do our project accounting at a profit and loss level, yes, we know where the income comes in on projects, but all our other expenses need to be distributed evenly to those projects as well. And we'll talk about that again in a second. The other thing, like I mentioned a bit earlier, is it's also critical that you do this in real time, because things can change very quickly. So as soon as you've got expenses in, you need to understand where your project's sitting, hopefully at a daily basis, but certainly at a weekly and at the worst case monthly basis. All right, so project income is quite easy to understand. You can just look at all the invoices you've sent to your clients, so you can understand just what you've earned. But where it becomes a little bit more tricky is on the expense side. It's how do we allocate expenses to projects? So there is direct expenses. So these are things like employee expense claims. These are sub-consultants, any other bills that you might receive specifically for a project. Again, those are actually quite easy to attribute to a specific project. So you can just attach those to a project. And then the second one is time costs. And this is where it gets all a little bit hazy and people kind of get a bit confused. But it's also the biggest single cost in our business. So if you look at your typical consulting engineer practice, it's at least 70% of your costs are salaries of technical staff. So they're the biggest expense in your business, but they're also the hardest to attribute to that. So you need to have a system that makes sure that you're attributing them correctly to all your projects. Another little top tip, just as an aside, and I see this a lot specifically in South Africa with our engineering clients specifically, is we need to charge for your disbursements. So for some weird reason, I don't know what the history behind it is, maybe someone will know, is we've got into a habit, or a lot of consulting engineers have got into the habit of absorbing project disbursements into your own fees. So if you have to travel to site, if you have to incur a specific expense for the client, is you just absorb that and you take that as part of your cost of doing the service. Whereas I see everywhere else in the world that we deal with, and funny enough, even regionally in South Africa, it changes quite a lot. But you rightfully can charge your client for stuff that you're doing for them. That is kind of the basis of business, is if you're incurring a cost on behalf of your client, you can charge them for that. So don't be scared to do that. And it's obviously straight away will improve your profitability if you're not doing that. Okay, and then the third and final sort of tool would be forecasting and budgeting. So the previous two, like I said, are backwards looking. They're looking at either your whole company performance or at a specific project performance. And then the third tool would be to look forward at what's going to happen in the future, the what if. And that consists of three things that we need to worry about. And we'll dive into this at the end, is understanding your pipelines, what projects are coming in, what leads and opportunities are we tracking, and then looking ahead and saying, okay, when might that income come? When might we earn those fees? When might we spend that money in the future? And understanding what the impact is for us. And we, like I said, we'll delve into this in a bit more detail a bit later. Okay, so that's the end of section 1 out of 4. So I'm just going to stop here, Wally, and just see, do we have any questions? And if anyone does have any questions right now on the bits that we've covered so far, please just put them in the chat, sorry, in the Q&A box, not the chat box, and we will answer them.
Thank you, Simon. But just to remind people that please don't raise your hands because the audience can't speak. So we can only answer questions in the Q&A. The first question that you can answer is, how do you determine, it's from Herman Bierman, how do you determine a value per hour for software subscriptions if you want to pass it on to the clients per project? And then he carries on, what they do is we add all the subscriptions for the total firm, say 250K per year, and then divide it by 12 months, weeks, days, and hours. So we end up with 142 Rand per hour. So it's essentially, it's one question. Actually, I see it goes on a bit. Maybe I'll just quickly read that. The third part of the question is, the problem is that we cannot invoice every hour of every day.
All right. So, Herman, I'd say it sounds like what you've done is correct. So just to reiterate what I think he's asking is to say that, okay, we're buying, let's call it an AutoCAD license, and we're paying 100,000 Rand a year for AutoCAD, is how do we attribute that cost to individual projects? Okay. Now there is, just before I answer that question properly, there is another category of subscription costs that may be directly attributable to a project. So say, for example, you have to subscribe to a Synergy license because the specific project is forcing you to use Synergy for that project delivery, and you don't use it for any of your other projects, but it is for this one. So that's actually quite easy. You say, okay, whatever that cost is, goes to that project. But if it's an overall expense, so AutoCAD's a great example, or insurance, that's what we would call a company overhead. So I won't go into the exact mathematics today, but I can share some articles on exactly how to do this later if you send me an email. But basically, all those expenses go into company overheads. They do have to be, like I said, attributable to all your projects. You have to include those in your project costs. You can't just ignore them because it is the cost of delivering the project. Having AutoCAD is a cost to deliver the project. And the way you've done it is, I think, correct. So basically, you attribute your annual costs across the business. and whether that's AutoCAD, rent, water, electricity, all those things, you add them all up together and you look at that as a ratio versus your salaries. So if your salaries are R1 million a year and your overheads are 500,000 Rand a year, then you've got a ratio there of 1 to 1.5. Okay. And then when you're doing your time costs, every single hour that you've costed out, and in terms of how much you pay salaries to someone, you need to multiply that by 1.5. So if you spend a lot of time on one project, you'll essentially be adding more of that subscription fee to that project. So it basically proratas itself out. But basically you're inflating your labor cost, your hourly cost needs to be inflated by your overhead costs, which include things like subscriptions. And like I said, again, if anyone wants, I can send you a link to a blog article we've got that spells out step by step exactly how to do this calculation.
Thank you, Simon. There is another question, but before we go there, can I just say that if you send us, CESA, the articles, we will send it to all the delegates in the audience. So no one misses out. And this question, Simon, is from Akshay Samka. It says, hi, Simon. Do you recommend an engineer or project manager or accountant to handle the project accounting and cash flows and budgeting portions?
I would say probably, I don't know if an engineer is the right, like again, a very important bit to think about, or a framework to think about, is that if you've got an engineering skill and you're very technical, is that you should be spending that skill on project delivery, not on project admin. So I wouldn't say necessarily an engineer. Again, it depends how big your business is, but if you can afford to have an administration type role doing the project accounting internally, I think I would rather do that. Accountants, like I said earlier, they tend to focus on looking at company level reporting, and they don't always know how to do the project accounting or even want to do the project accounting level. So what we generally see is that the project accounting bits and the forecasting bit gets done in-house and the accounting bit gets done outside, outsourced. But also just to say, obviously, is that there are tools that will allow you to do those components and make you be much more efficient to do them, obviously, like fresh projects. But also, if you wanted to use spreadsheet templates or things like that, depending on the size of your business, there are ways that you can do that more efficiently and or using less skilled people. So you don't have to have a very highly qualified engineer to do all of this if you get your systems and processes in place.
Okay, thank you, Simon. We've got a couple of email addresses, but just to say again that if you registered to view the webinar, we will send you the articles that Simon will give us. Simon, maybe you'd like to continue?
Right, let's go. Okay, so the next bit is profitable projects. So we're now going into the three main areas you need to worry about. And the first one is making sure your projects are profitable. Okay, so project by project, you can't just look back at your business. This is the point of my talk. You can't look back at your business a year later and say, oh, it all went wrong, we didn't make money. We want to look and be proactive about looking at a project by project basis to understand which projects are making money and which ones aren't. And there's 3 steps to this. It's 1, make sure you get the fee right. Okay. And this is potentially a controversial thing to say, but I would say do not use fee scales. Okay. Do not use the EXA fee scales. I could talk about this particular bullet point again for another hour. I think they're the devil. I don't think anyone should use them. I think they've made engineers lazy. We don't think about how we get to come up to our fees. And we just discount, and then we just discount more to try and beat the next person and discount more. And it's led to a race to the bottom in our industry. Having said all that, I do understand there are cases where you don't get to have that choice. But if you can at all, do not use fee scales. If you do use fee scales, also do with the next point, a bottom-up calculation, and see where the fee scale brings you versus your own independent calculation. and decide whether or not you want to do that job, and be willing to walk away from jobs if it's going to mean you're going to lose money. Like, why set yourself up to lose money on a job if you know you're going to spend more than what you're going to earn? Okay, so the right way to approach it, in my opinion, is to do your calculation from the bottom up, understand at least what the minimum fee is that you should be charging based on your hours that you're going to be spending on the job, and then make a profit on top of that. Okay, so what are the steps to that? So the first important bit is to understand what the value is that you're adding. What is the problem that you're solving for your clients? It's not just about selling hours. You're actually solving a problem for them, and understanding what that problem is that you're solving is important, because there's a value to that solution to the clients, and they'll be willing to pay for that value, even if it only takes you 1 hour to do that. There's a value that could be 100,000 Rand for that 1 hour, if you understand that correct relationship. The second important bit, and again, we're not good at this, again, because of fee scales generally, is to understand what the scope of services is. What is it is that you are delivering within this fee, and what are you not delivering within the fee, and to spell that out. And then thirdly is to calculate for yourself is what is the cost to deliver that job. So what is the time cost? If I'm going to spend, how many hours is it going to take me to do it? How many days, how many weeks? What is the cost for each of my individual resources? And what is that multiplied out? And then, like I said earlier, is disbursements and other third-party costs and sub-consultants. Make sure you build those into your budgets as well. And then you'll get to a baseline, and that's the minimum fee value that you won't make any profit on that, but you know that anything fee below that, you shouldn't be doing the job, or you need to change your resources, get cheaper resources. And then you can decide just how much profit you can afford to deliver within the context of point one, which is what is the value that you're adding to the client. Again, we'll send through some information via Wally on this. This is what we call our value add canvas. And this is just it's a 7-step process for going through fee calculations. So understanding who your customer is, what their problem is that you're solving, and what your value proposition is. So how is it that you, the engineer, can solve that customer's problem? If that's the first step to understanding all of that. And it gives you, we haven't even talked about any money here, but it quantifies just what is that value that you're providing, because that's why your clients are coming to you at the end of the day. And then you go into detailing your activities and services, scoping out exactly what you will and won't do. Do we have the skills and resources to deliver that? And then finally, your cost to deliver that and the fee that you're going to charge for that. So again, we'll send through the details behind this, but this is just an interesting way to think through your fee calculations if you want to when you deliver them. Okay, the second important thing about understanding or making sure that your projects are profitable. So we've talked about the fee, making sure that your fee is right when you start off. But then once you've won the job, is making sure that you're tracking your costs accurately on the project. So this consists of two things again, is the direct costs, like I mentioned. So these are going to be your expense claims from your employees. It's going to be your supplier invoices, anything that you get a bill from. It's quite easy to attribute to the specific project. And then like I said, the harder part, but the most significant part is your time costs. So here it's timesheets. You have to do timesheets, I'm afraid, if you want to track your costs accurately. There's no silver bullet. And if you get it into your business and understanding why you do timesheets, and just as a little side, the reason why you want to do timesheets is you want to make sure you understand your costs properly on projects. And if you do understand your costs properly, you'll understand what it costs to deliver a project. If you know what it costs to deliver a project, you'll get your fee right. If you get your fee right, then you'll start to make money. If you start to make money, then everyone will start to, get better salaries and better bonuses, and won't have to work 60-hour weeks. They can work 40-hour weeks. So I know timesheets are sometimes seen as a little bit of a burden, but if you put them in the right context and you explain to your staff why they are necessary, what I've just said, then it becomes a lot easier for everyone to participate in it. Okay, so this is going a little bit back to Herman's question earlier, is just how do you understand what your time cost rates should include? So when someone does 1 hour on their timesheet, How do we work out what the cost of that 1 hour is? So the obvious one is obviously their salary. So we take, more, the more you earn, the more you're going to cost per hour. But the critical bits that shouldn't be ignored are two things. Firstly, your utilization, your non-project time. So when someone's on holiday, when it's a public holiday, when they're doing training, when you're sitting in a CESA conference like this, that still costs you time, costs you money. But there's no project covering those costs. So that time that someone spends on not doing projects has to be incorporated back into your underlying costs to the project. And that's why utilization is so critical in a consulting engineering practice. Is you've got to watch this like a hawk, is that people should be spending sort of 70–80% of their time on projects. It obviously changes with seniority. The more senior you are, the lower that gets. And again, we've got the data from our database to support this. But as soon as your utilization starts to slip, all your profitability as a business will go down. So you got to have a laser focus on making sure that as many people are working as long as possible, as much as possible on project work that you can. And you can understand how that just plays itself out, is that if you're spending too much time doing admin, doing training, training's a good thing, don't get me wrong with that, but if you spend too much time doing non-project work, that basically means you need to hire more people to deliver the same amount of projects. Whereas if you can be more efficient with your staff, you can use fewer people to deliver the same amount of projects, and then there's obviously more fees to go around. And then the third component, as you mentioned with Aman, was that you need to include your overhead costs. So that includes things like subscriptions, as per his example, but any other costs, rent, insurance, all those things need to be included in your hourly rate. So when you do an hour on a project, all of these things are contributing towards that. So you're getting a real view of what that project is costing you to deliver. Okay, and then the third and probably the most important bit that we've seen from our customers is understanding scope creep to make sure your projects are profitable. So where we have customers who are very particular about not doing an hour of extra work unless they've been instructed to do so, they are wildly profitable. Whereas, like I mentioned at the start, is that engineers by nature will want to solve problems for a client. So if the client comes to you and throws a new problem at you, you will go off and do it, and you'll work overnight and you'll come back to them the next morning and give them the answer. But you've got to make sure that the scope doesn't creep, because that's where all the profit gets eroded. And we've got the data to show this, is that in stages 1 to 4, all projects tend to make a profit. And then when you get to stage 5 and 6 on site, as things start to change, all that disappears. So what we recommend is that, like I said earlier on, is that agree your scope with your client. List out the things that you will do as part of your scope, and almost as importantly, list out the things that you're not going to do, because if that's not spelled out, there's an assumption on the client side that you will do it, and an assumption on your side that you won't do it, and you'll just end up both being angry with each other. So spell out the things you will do, spell out the things you won't do, and then spell out both a rate for if there are any changes to scope, and a process for how those changes must happen. So it doesn't have to be complicated, but just, we will only work if you send us an email or fill out this form, and we will give you a quote, and then we'll do it. Like, just agree that process. At the start of the project, the client will think they won't use it, but then over time, it's not a surprise when you get to the end and suddenly there's changes. You say, okay, as per our agreement, this is what we said we would do when changes happen. Okay, so like I said, probably the most important way where we lose a lot of money as businesses is letting scope creep into all our projects. Okay, right. Do we have any questions at this point in time on project profitability?
Yeah, Simon, the two questions, very similar, are they both relate to timesheets. Manus Leon has asked, any recommendations on timesheet tools, project accounting? Some options available on market take up a tremendous amount of time especially when working on multiple projects, and results in timesheets being neglected or not being updated in real time. And the second one is from Tutuko Buthelezi. What software package would you recommend to capture and track employees' timesheets? So they're very similar.
Okay, so it's given, I think timesheets are an administrative burden. So I don't think there's, and we've tried to solve this at Fresh Projects in different ways. By the way, Fresh Projects does timesheets, but there is no silver bullet. If we need to split your week down into understanding just how much time you spent on each project, it requires some sort of input and intelligence from a person to tell a system what that does. And you know, we've put in places over the years some things to make that a lot easier, but I think you need to get your head around that there's a little bit of administrative overhead that you need to do with timesheets, but the benefits from doing that are massive. So if you can do that. Two is, and we tend to see it's the more senior staff that are worse with timesheets. And we see that again and again. But even if you get half days done on the timesheet, so you spend half a day on this project, half a day on that project, at least you're getting something as to understand where projects are sitting. You don't have to worry about minute by minute timesheet capture. You want to try and get a good idea of which projects are profitable, which projects are not profitable. And you may be up by 5% or 10%, but at least you're getting a view and you know which clients you should be working for and which projects are in trouble. Like that's where it would come from. And obviously, again, the other point to make is nowadays with mobile phones is that you get timesheet apps that are quite easy to use. So you can do that while you're sitting in a client meeting and you've got 2 minutes extra, they're talking about something else. Quickly capture your timesheet. And I think the important bit is just to get into the habit of doing it regularly, either on a daily basis or weekly basis. And it's like everything like exercise. If you just do it regularly, it'll become, you know, second nature and it won't be such a burden. But off the top of my head, some of the other ones, so Toggles, a well-known timesheet app, Harvest, T-Sheets, they're all pretty similar, and they all allow you to capture time. The trick is not to just look at timesheets. So the other option obviously is just spreadsheets. You can capture time in spreadsheets, but all of these lead to a problem is that it's one thing capturing the time, but then you also need to analyze the time. So you need to attribute the time to projects. You need to compare that to your income. You need to, if you're doing on spreadsheets, that becomes an administrative nightmare because one person's called the project, spelt it one way on the timesheet, and the other person spelt it a different way, and it just becomes a disaster. So having an all-in-one solution where it all just works together is advisable. Again, you know, that's what we do as Fresh Projects. But having the ability to do your timesheets, your invoicing all together in one database, that's going to save you a lot of time in the bigger picture.
Simon, sorry, that was a great answer. Greg Tucker's got a question. Do you have any data that indicates target utilization rate for each level of technical resource?
Yes, we've got a lot of data that represents this, and we've looked at it in quite a lot of detail, and the same trends come out all around the world. And it is, if you are a more junior, more technical, more focused employee, so if you're just like a first or second year graduate engineer, and really you should be coming to work, sitting down, working on projects and going home, with a little bit of training and public holidays and all that sort of stuff, you're looking at a maximum of about 90% utilization, probably about 87%. And then that goes downwards the more senior you get. So you generally tend to see in slightly bigger practices, so say where there's 30, 50 people, is that your directors, your partners, your owners who are running the business tend to be around about a 50% utilization. So for every hour they spend on a project, they're spending another hour running the business. And that's a bit of a travesty, because the reason why someone will come to your engineering firm is because they want those people, they want those experienced heads, they want them working on the projects. And yet those people are spending half their time doing things like accounting and HR and all those things. And it's really, like I said earlier, is an important bit, and one of the sort of insights you get out of starting to analyze this and look at it properly is you can start to see which of those directors, if you just did one less day of admin in a week, their cost to the project will halve. And there's, again, I'll send through an article that explains exactly how that utilization curve works. It's not linear, it's actually exponential. So the more time you spend on non-project work, your cost just goes up exponentially. So if you can reduce the administrative burden on your senior staff, you will have an exponential effect on the profitability of your projects and your company. And what that means practically is doing but
Simon, you're freezing a bit.
Sorry, Waddy?
Yeah, Simon, you froze for about a minute or half a minute.
Okay, I'm just quickly going to change connections.
Okay.
Hi, Waddy.
Yeah, you're back with us.
Okay, sorry about that.
So just the last part of that answer is missing, I think.
Okay, so just to summarize, is utilization is very important. It is most important with your senior staff. They tend to be the ones who do more of the running of the business, and that's a travesty. If you can improve utilization for senior staff, you will become much more profitable very quickly. And that practically means being able to, or that you need to hand over, identify the tasks which those senior staff are doing, which can be delegated to a more junior staff member or an administrative staff member, and delegate and get your senior staff working on projects.
Thank you very much, Simon. I think you better carry on with your presentation. Thank you. Hey.
All right. So so the three main things we were focusing on was profitable projects, cash flow, and managing your pipeline. So this is the second bit, is cash flow. And this is really just about invoicing at the right time and collecting the money on that invoice. So it's important to know when you should be invoicing on projects. So a lot of projects, I know we'll be given a cash flow or an invoicing schedule from the clients or from the QS, and there's not much you can do about that. And in a way that is useful because it gives you security of income across a project. But if you're doing milestone billing, or if you can afford to do it, or you can agree to do it, is to know when you invoice is important. So the short answer is invoice as soon as you possibly can. Even if that means invoicing ahead of your workload and keeping that money in the bank. And I'll show you in a second what graph why that's important. But knowing when to invoice, so there's two ways to do this. The very simplest way is just to look at your costs. So if you spent 500,000 Rand on delivering a job, you should have invoiced 500,000 Rand at least. So again, you need to know how much you spent on a job, and that comes back to timesheets and expenses. The slightly more advanced way of invoicing is to look at progress. So if you do set up an initial budget, we know the job's going to cost us R1 million. We've spent 500,000 Rand, then we know we're 50% of the way through the job, and therefore we should have invoiced 50% of the fee. So it's a slightly more complicated maths there, but not too complicated, but it's more that takes into account your progress and it brings in profit earlier on, whereas the basic version doesn't bring in profit initially. But either way, the important bit is invoice as soon as you can, as soon as you've done the work, try and get that invoice out the door. Okay. The flip side to that is to make sure the invoice gets paid. Again, a big problem in South Africa. And with specific clients, it can get even more problematic. But what are some hints to just try and make that work? Firstly, get everyone involved. So don't just leave it up to your bookkeeper to chase the invoicing or the payments of the invoices. Get your project engineers to speak to the clients, and you can do good cop, bad cop. So the project engineer can come in and say, oh, look, my boss said, unless we get paid, this isn't going to happen. So yeah, get everyone cognizant of which invoices haven't been paid and make sure that the people who are working on the projects can try and chase that money. And this, again, it goes back to our nature as engineers. We would probably go bankrupt before we do this a lot of the time, but stop working if you don't get paid on a project. And it's amazing how quickly you will get paid. And we almost embarrassed to say, oh, I haven't been paid, I'm going to carry on working. It's a weird nature of engineers. I do it myself, I'm an engineer, is you deserve to be paid. You've delivered a service. So if you're not getting paid, you shouldn't deliver the service. And sometimes you just need someone to knock that sense into you. But yeah, you can stop working if you're not getting paid, so long as you know the issues on the project. And then more a bigger picture thing, but the same things. If you look across all the projects and you do repeat work for certain clients, you'll very soon start to see and pick up the patterns of the clients who are not particularly good at being paid. And when the next job comes along from that client, walk away. You can, and we'll talk about go and no go in the pipeline later, but that's one of the data points you should be looking at, is not expecting someone who doesn't pay well to suddenly start paying well. Okay, so analysis of your clients is important. All right, and then the third and important bit about cash flow is managing working capital. So what is working capital? This is really just how much money you need to fund your business to keep it going. So it's the difference between what you've got in versus what you need to pay to keep your business going. So if you were selling baked beans at the supermarket, you would have to spend a whole lot of money to buy 10 tons of baked beans before you could sell it. And that money that you need to buy the baked beans is called your working capital. In a consulting business, in an engineering consulting business, your working capital is your time. So when you hire an employee, an engineer to come join your business, you've got to pay them a salary for 1 month, 2 months, 3 months, 6 months before that time gets produced on a project, and that project results in an invoice, and that invoice gets paid. So however long it takes for that time that you paid the salary to become cash in the bank is what your working capital is. So you need to try and reduce the amount of working capital. This is true for any business in the world, is reduce the amount of working capital you need, because working capital needs to be funded. And that's basically, you need to take out a loan from a bank to get that money, or you have to, if you've got that money in your business already, you're essentially taking out a loan from your business. So rather than that capital working on something else, you're spending that money on your clients. And this is particularly dangerous in milestone-based billing, because you've got agreed to invoice right at the end of a milestone, and all the time up to that becomes risk work or working capital. Okay, so this is an example. It's a graph that I actually pulled out of Fresh Projects this morning from one of our clients for a project, and it shows just how this project progressed over time. So the green line at the top, that's the total fee that the engineer agreed with the client. So it's 3.3 million Rand. And that sounds like an amazing fee for this project, and it is. But what happened in reality, and this project started in May 2019, is they started working and they started doing their timesheets, and this is how we can tell this. And they worked and they worked and they worked and they worked for 32 months before they were able to raise the first invoice. And the cost of that time is close to just short of R1 million. So this particular engineer spent R1 million on this job before he got R1 back in. And he had to have had that R1 million in his bank account to pay the salaries over those 32 months. And this is the danger of risk work. Very big problem in South Africa, as you can see from this graph, and milestone-based billing is that this can very quickly grow out of control. And if you're not invoicing early enough on projects, you're basically funding your clients. So you're giving them a R1 million loan for free on this project. Okay. And even now, in June 2023, this particular project has not covered its costs yet. So this engineer is still funding the client to this day. And there's a cost to that. Obviously, if you're borrowing R1 million from the bank, they're not going to give that to you for nothing. You've got to pay that money back with interest. All right, so that's the end of the second session, which was about understanding cash flow. Let's see.
Yeah, Simon, we've got a good question here. I think it applies to a lot of our members. It's from Tando. It says, my name is Tando. Our greatest challenge we are faced with is that we submit a tax invoice to the client and they delay payments. Then when they can pay us, they request for us to revise the invoice date and issue a credit note to override the first invoice sent. How do we avoid such occurrences when it comes to declaring at SARS, where we declare VAT on a monthly basis? Mind you, most of these clients refuse to take pro forma invoices. Please advise.
Ando, asking all the hard questions today. That is very much prevalent. And it's certainly, again, when it comes to one of my points earlier, understanding which clients are bad payers, is we see this behavior again and again with specific clients, and they're doing it for the exact same reason that I've just talked about. They're managing their cash flow. So they're trying to pay out as little as possible to their suppliers until they've got the money from wherever they're getting it on their side. So they're doing the exact same game that you're doing, as they're playing the same game. And it's, I've seen this myself many, many times, and I could name and shame some people, but where you would send in an invoice, they'll wait until the 60 days or the 90 days and when it was due, which is in itself a travesty, paying 90 days. And then on the 89th day, they'll send you an email and say, oh, your invoice is wrong. Please, can you void it and reissue it? And then that clock starts again. And it is just a game that they play, and it's immoral, and it's not great. And I understand exactly where you're coming from. And then, like you say, the whammy on that is that you have to pay VAT on your invoice before you've received the cash, and then you're out of pocket. So the sort of workarounds are seen, and this isn't legal, if you like, in the terms of the way that accounting works, is to do pro formas. So just as an aside, the basis on which accounting works is called accrual accounting. So what you're meant to do is you're meant to report your income when you've done it. So even if you haven't even raised an invoice, if you've done the work, you should be reporting that as income. So that's the basis on which accountants work and the way that you should be reporting, but it doesn't play nicely with this problem. So we do see a lot of our customers doing pro forma invoices. And, one way to do that, even if they don't accept pro forma invoices, is to make sure that your invoicing system and your accounting system are different. So you can raise the real invoice that goes off, but it doesn't necessarily get reported to the accounting system, which then would trigger onto SARS. So it's a little bit of a trick around. It's basically a pro forma, but that's one workaround. The other thing, obviously, is to make sure that you get those invoices right as soon as you can. So what we often see as well is that some of our clients will raise a nominal invoice to start with, even if it's 100 Rand or 1,000 Rand or something like that, just to get those gremlins out. Because sometimes it is genuine gremlins. You don't have the right purchase order, your format of your invoice is wrong, it's not malicious. So if you get that invoice up early and you say, this is just a test invoice, we just want to make sure the whole process works, that you've got our bank details right, all that sort of stuff. And you get that first invoice out and make sure that it gets paid as quickly as possible. All right. I'm going to move on then to the third and final section, which is about making sure you get the right type of jobs coming in the door. Okay. So obviously we want as many jobs as we possibly can, but it's also as important to make sure that you're doing the right type of work. Okay, and again, there's 3 elements to this that you need to worry about. One is just making sure that you manage your pipeline. So you need to actively control this, whether this is a spreadsheet, whether this is using a pipeline management tool, CRM, whatever you want to do, is making sure that you keep a list of all your leads and opportunities, and that you segment and categorize them. And what I mean by that is that you're not just worrying about the leads and opportunities, but you're also saying, okay, what type of lead is this? Is it a public sector work? Is it private sector work? Is it retail? Is it roads? Is it bridges? Whatever it is, whatever those categories are that make sense to you, you need to tag all those leads and opportunities with them. You could also maybe by lead source examples, and then you're able to do the analysis and understand where you're good at winning jobs, and later on, if you take it through the whole project lifecycle, if you do the whole project accounting, but you can look backwards and say, okay, which projects are the most lucrative? Where do we make the most money? And that feeds back into your pipeline and says, okay, we want to focus on A, the jobs that make us the most money, and B, that are the easiest to win because we are good at doing those jobs. Okay. This is an example of pipeline management tool. This is just showing you your leads and opportunities and how they progress through the stages, and just making sure you're tracking them, you're not dropping the ball, you're following up on all your leads and opportunities, and then you understand where they're coming from. And like I said, you also should be able to segment them and see which segments or which categories your leads and opportunities are coming from. Okay, the second point here is to make sure you have, even if it's a 2-liner process or a mental process, is qualify your leads. So don't just chase after anything that comes in the door. Make sure you have a mental process where you're looking at the lead and you're making a conscious decision whether or not you want to do that job or not. And that involves a number of different things, but most importantly, looking at the client. So back to Tando's comment about the specific client who plays, tricks with their invoicing, or a client who never pays. So look at them and say, okay, have we worked with them before? Was it a good experience? Or maybe speak to your colleagues. Have we worked for them before? Was it a good experience? Do we actually want to work for that client? Because there's one thing, having a R1 million job, but if that job's going to cost you 2 million rand to deliver, you might as well not do it because you're just losing money. So rather don't work for specific clients if it means you're guaranteed to lose money with them. The second thing obviously is scope. Can we do it? Do we have the skills to do it? Do we have the people to do it right now? And can we actually deliver a good job? Because the other thing, as you know, our industry very much works on reputation, works on referrals. So if you do a bad job, it's just as, that's probably more of a deterrent in the future for clients to use you on other jobs. So make sure you do have the skills and the capacity to deliver that job. Probability, do we even have a chance of winning it? And then kind of the basis of everything I've talked about so far is, will the job actually be profitable? If you're using fee scales and you're having to discount and you realize you're not going to do that job at a profit, don't carry on with it. Okay. All right. And then the third and final element of looking ahead at your pipeline, looking ahead at the right type of jobs coming in, is trying to do this what if scenarios. So, you might have 10, 20, 100 different jobs that could come in, and that combination of how whether they do or don't come in has a massive impact on how your business will play out in the next 6 months or 12 months. So to do this, again, use a forecasting tool if you can, or just a spreadsheet. It doesn't have to be complicated, but you want to schedule out project by project. So the rows in your spreadsheet, if you like, are going to be project or opportunity by opportunity. And then month by month, a guesstimate of when that income might come in. And at the early days, that might just be, we think this job's going to start in December and it's going to run for 12 months, and you just flatline that income. As you get, closer to agreeing the fee with the client, you might have a specific shaped cash flow that you want to do on that. But basically, you want to put in your anticipated monthly income on your jobs. And then if it's a secure job, you put that in 100%. And if it's a potential job, so still an opportunity, we talked about the probability in the previous step, is just have the probability and then weight that income by that probability. So if you think you've got a 50% chance of winning it, put in 50% of the monthly fee, and then you can scan down and total up the columns, and then you get a good idea of what is the weighted probable income month by month going forward. And that's made up of your secured work, the ones you've won, as well as a portion of the potential projects according to probability that we think we'll win. And that will give you the very important answer to the question is, will we be able to pay salaries in 3 months' time, or in 6 months' time, or in 12 months' time? And just as a side, someone asked earlier about understanding benchmarks, if you like, in the industry. And very much in South Africa with engineering firms, we see that your head secured workload is generally not great. It's generally sort of 2 to 3 months ahead where you'll be able to cover salaries, and then you're trying to fill up that gap going forward. So it's a very difficult business we work in. But again, if you listen to all the things we've talked about today and you get those in place, you'll start to get a better confidence with that forward forecast in terms of where things are. And then the flip side to understanding your future income is understanding your future outgoings, your monthly resource requirements. So it's exactly the same process. Is look at all your secured projects and all your potential projects, and look at how many resources. Again, this doesn't have to be Monday is doing this, Tuesday is doing that, Wednesday doing that. It can be literally as simple as for 3 months, Joe is doing this project, and for 12 months, they're doing that project. And they're going to spend 20% of their time on the project, or 5% of their time on the project. So that is what you want to do again. So same process, all your secured jobs, you can look at, put those down as 100% probable in terms of what the resource requirements are. And for the potential jobs, again, you can weight it by probability and say, okay, we've got a 10% job, a 10% chance of winning this job. So we can put in 10% of the resource requirements. And that will give you a forward-looking view of your business, again, very high level, month by month, for 6 months or 12 months, how many staff members or how many engineers we're going to need to deliver all our projects. And you can compare and contrast that to your income on the left-hand side there and see, do we have enough income to do those projects as well? Because what happens, as you would all well know in our industry, is that firstly, even if you're just hiring today, it's going to take a month to find the person, a month for them to give notice, and probably a month to get up and running. So you're like 3 months away in the best case scenario of getting a resource in, usually longer. And at the same time, our industry is very cyclical. So it goes through these boom and bust cycles. And what tends to happen is everyone hires. They've got so much work, they don't know what to do. And then they're overstaffed. And then they have to let go. And then they're understaffed, and the cycle turns again. So having a good forecasting tool where you can have confidence in what it's going to look like in 6 months' time and 12 months' time allows you to jump ahead of all your competitors who are hiring at the wrong point and firing at the wrong points. And you can make sure you get the quality engineers who don't get chased away by the fact that you have to do all these retentions all the time, and you've got security and you've got stable outlook as a business. Okay, and then this is just a screenshot of what an income forecast might look like. So here are all my projects. who the client is, what the probability is, the percentage column there, and then what the monthly income might be. So just forecasting monthly what that income might look like on your projects. And obviously the total at the bottom is the bit that's important. It's not shown here, but you would total that up. And then this is the flip side, which is the resource forecasting, which is understanding the overall requirements for all your different staff members for each of the projects. So if you look at each project, just how much percentage of time they're spending on each project, and you sum that up and you get to an overall total for each staff member. And in this case, we can see that, Archimedes has got a lot of capacity. So, and Christopher Wren is way overloaded. So he's got too much work to do. So we need to take some of the projects from Christopher Wren and get them to Archimedes. And then if you aggregate this across the whole business, you'll then get a view of, do we have too little work for all our staff members or too much work? And if we do have too much work, how many more people do we have to hire? All right. And I think that is it. So just to summarize very quickly, what we've gone over is we look briefly at the different types of financial tools that you can use. So corporate accounting, project accounting, and then budgeting and forecasting. And then we looked at the 3 important things that you need to worry about as a business. And if you look after those 3 things, you'll be fine. And that is making sure your projects are profitable, managing cash flow, which is invoice early, collect the invoices as soon as you can. And 3 is managing your pipeline, winning the right type of jobs and looking ahead to understand, are those jobs going to cover your costs going forward? Okay.
Thank you. Thank you very much, Simon. There's just 2 small questions. The start of the last one first. It's a very interesting topic. Thank you. Can I please request the recording? Just to tell everyone that maybe you missed the introduction, is that the recording will be available on our website under the YouTube portion of the website. And we will also be sending out the link for the recordings. And then the actual question is, it's from Tutuko Butelezi. What pipeline software package are you using? I'm referring to the slide you presented.
So again, I feel like I'm blowing my trumpet too much on this, but this is a screenshot out of Fresh Projects. So yeah, this is a very simple pipeline. You do get, again, hundreds of different tools that you could use for this. Not a lot of them are, again, focused at built environment firms and the way we work. We always work in 6 stages or 7 stages, or whatever it is. But yeah, the important bit is just to be able to have different project stages, to be able to make sure you can track your leads and opportunities, and understand what the fee values associated with that is, to associate a probability with each one, a start date and a duration. And if you've got, so for each lead, just to repeat that, you want to know what is the potential fee, it could just be a guess, what is the probability, what is the start date and the duration. If you've got those 4 bits of information about all your leads and opportunities, that allows you to forecast your potential income going forward. Yeah, so that's it. And this is just to answer the question, is that this is the pipeline from Fresh Project.
Thanks, Simon. Are you going to carry on, or is it the end of your presentation?
I think I've imparted all my wisdom for today.
Thank you. It's great wisdom that you have imparted. And so I'd just like to say to our audience that colleagues and friends of CESA.
Wally, if I can just, you've accidentally muted yourself.
Oh, sorry. So it's colleagues and friends of CESA. At this point, we've reached the end of the webinar, and I'd like to thank Simon for availing of his time and for sharing his knowledge and thoughts with us. He's done truly a great job. And of course, a big thank you.
Wally, it's gone mute again.
Sorry. I'm doing. Okay, take my hands away from the keyboard. And so it's a big thank you to you, our delegates, for supporting CESA and attending the launch of CESA's practice note number 99. Just a few important points before we close our webinar. First, we'd like to invite you to submit any comments or suggestions you may have regarding our webinars with a view to improving them and making them more useful. You're also welcome to suggest topics that you would like addressed at future webinars, and you can send me your comments and suggestions at wally@cesa.co.za. Secondly, I'd like to kindly request delegates to complete the satisfaction survey that will pop up on your screen and the web link that will appear in the chat room. The purpose of the survey is to provide us with your satisfaction ratings or feedback that will enable us to improve our future webinars. Thirdly, just one more point after this. Delegates registered with CESA may claim 0.15 CPD points for attending this webinar as per our webinar attendance list. And for ease of administration, CPD certificates will be sent to delegates upon their completion of the survey. And finally, you're welcome to email me with any questions that were not answered during the webinar, or if you need a web link or some reference point, please email me at wally@cesa.co.za. And again, just to thank you greatly for your attendance and participation. And we hope to see you at another CESA Best Practice webinar. And we wish you a good day further. Thank you.